Network webinar on alternative deal structures to maximize impact from the fund perspective. I'll give you a very brief introduction, and then I will turn it over to Aner from Pi Investments and Rodrigo Villar from Adobe Capital. Why are we talking today about this issue from the standpoint of the transformative finance principles? I think we have all noticed in the industry that venture capital is not quite cutting it to fund the type of inclusive and impactful businesses that we are interested in. On the inclusive side, there are some pretty staggering statistics around who venture capital is flowing to that we'll look at in a second. And we think that there are alternative structures that might be more conducive to funding the type of entrepreneurs that we would like to see funded in this space. There's also an aspect of the tail wagging the dog, as we often talk about in the context of our work. It should not be the investor primacy that determines what gets invested into and how. And in the case of venture capital money, oftentimes the determination is really more from the standpoint of what suits the interests of the investors rather than what really would be helpful to the entrepreneur and to the company. Another point that we've seen with a lot of companies that have taken on VC money is the issue of mission drift. And lastly, looking at it more positively as a matter of opportunity instead, the type of limited partners that are interested in this work really have oftentimes more flexibility in both in choosing the funds and in the case of fund managers in structuring the funds so that they can use new models and not conform to a VC model that might not work. As I was mentioning around the inclusiveness or lack thereof for venture capital, here we're just putting up some race demographics for the United States from the latest census. So the 67% of the US population is white or Asian, and they receive 98% of the venture capital that is allocated. That means that Hispanics, who make up 17%, get 1% of venture capital. And Blacks and African Americans that have 13% of the US population get only 1%. So there is something that is not working there that has been documented fairly well. There was an interesting case study from McKinsey last year in a report on inclusiveness that looked a little bit at the self-perpetuating issues of who gets funded in the VC space. On the mission drift point, I just wanted to mention a couple of things. I decided not to include them in the slides, but we've seen just a few days ago the case of LendUp getting fined. LendUp is a fintech company that got fined by the California regulators for predatory lending, even though they are supposed to be in the anti-predatory lending space. And while some folks say, well, this was at the very beginning of the company, it was just a mistake, it also seems to evince that tendency when you take on VC money to grow as fast as you can, to maximize revenues from the get-go, and really have the strong possibility that you will drift from what your original intention was. So if there is this tension between venture capital funding and remaining true to the mission, then we really should be exploring quite deeply in the context of our work what other opportunities are there to make sure that the growth that exists, that happens, is the right type of growth, and that an exit in particular is not forced, or if it happens, that it doesn't lead the company to drifting from its original mission. All this was documented very well by Aner, who's joining us today in his blog post almost a year ago called The Square Peg Round Hole. And Aner will get a chance in a second to run us through some of those issues. The other thing that I wanted to bring up, and hopefully Bruce will be joining us to to mention this shortly, is the Impact Terms project. This was a project by Bruce himself and Diana Proper de Callejon that was created as a practical tool for investors to collate, discuss, and implement and annotate all sorts of terms, impact terms for deals, originally called the Term Sheet Project, that would offer alternative structures that might be more consistent with the type of funding that we are looking at. Bruce, if you are on, feel free to say a couple of words about the Term Sheet Project or the Impact Terms Project. Otherwise, you can we'll do so afterwards once you've been able to join us.
Andrea, can you hear me?
Yes, I can. Hi, Bruce.
Oh, great. Hi. Yeah, thanks for introducing the project. And you can find the website that has the current content of the project at impactterms.org with 2 T's. And at this point, we're looking for a few things if you're interested in helping or learning more. One, I think we will have a follow-up webinar just on the project to introduce it in more detail. Second, we are looking for people that would be willing to kind of participate in a focus group so we can learn more about how the site does or does not work for users. And then third, we are looking for people to partner with us both in terms of developing new content and also making the current content we have more robust. So just, I guess, get in touch with me or maybe through Andrea if you'd like to learn more, and also let us know if you'd like to participate in that follow-up webinar. Thanks.
Wonderful. Thank you, Bruce. And for those that are following the webinar from the Fuse platform, you will see on the slide the address is impactterms.org. And we are in the process of setting up a separate webinar just to go through that project and see how you all can contribute. I see that Rodrigo has joined us as well. Thank you, Rodrigo. Good morning. And I will turn it over then to Aner to walk us through his views on the need for these alternative deal structures from a limited partner perspective. Thanks, Aner.
Hi. Yeah, thanks, Andrea. Can you hear me okay?
Yes, perfect.
Yeah, so for those of you who don't know me, I'm Aner I'm a managing director with Pi Investments, where we invest on behalf of a single family that's committed to investing 100% of their assets in support of a more sustainable and just economy. We're also working with the Libra Foundation, a family foundation that is also committed its entire endowment or to investing its entire endowment with a similar set of values. So we work across asset classes. We make both direct. We think about the world both as direct investors and as limited partners in funds. Private equity, private credit, et cetera. And both those entities were not very thematically or sector driven. So we tend to think, for any sector, be it financial inclusion or sustainable food or clean energy, affordable housing, they're sort of all important. And for any one of those, we could support strategies that are that have the potential to be to have transformative impact on communities, or other strategies that could have very incremental impact, minor impact, or even negative impact. Right? You could have totally screw it up. So we tend to say we care more about the how than the what. Right? It's not so much whether we're investing in a fintech company or a energy company. Really is how they're thinking about integrating some of these transform finance principles into their approach, which would explain why our interest here in new tools as investors, right, and in kind of innovating on the terms, on the financial terms we use as well. See if this works. Yeah. So first, I think in terms of our, what got us interested in this topic, is, we were observing an asymmetry, a sort of an innovation gap, if you will, in the impact investing ecosystem. On the one hand, you have entrepreneurs, founders, where we're pushing them to really force their thinking and create, for-profit market-based solutions for social and environmental issues, right? We're saying, think as much as you can about, how to generate revenue while solving these problems, rather than, just defaulting to nonprofit models, right? And there's a lot, there's a lot of innovation around, and here's just a very random set of examples on the left hand side of the slide, right? Folks building business to creating quality jobs for formerly incarcerated individuals, making healthy food more affordable to low-income communities, rebuilding local food systems, providing education for inmates, and the list goes on and on and on, of course, right? And then on the right-hand side here, on the investor side, what we're using is pretty much the same one or two term sheets, right? We're still, 99.9 probably percent of these conversations, after you've heard what the business is and, well, what kind of capital are you raising, it's a convertible note, or it's your kind of standard um, venture term sheet. I mean, you could literally take the term sheet that was used for the, I don't know, seed round of Instagram and Snapchat, wipe out the name and write in one of these names, and it'll be very similar terms, and that made very little sense to us, right? And so that thing on the right hand side, which is way too small to see here, is the standard National Venture Capital Association preferred equity term sheet. So that's kind of where that square peg round hole analogy comes in, right? We're seeing business models of all shapes and sizes, right? And we're always trying to jam them into the same mold, right? So we want to support different kinds of businesses. We want to have different, a broader, more diverse set of tools in our toolbox. So a worthwhile reminder to ourselves is that most companies, not just impact companies, but in the world, including very fast growing companies, never do, never have, never will raise any venture capital or angel funding. All right, so this is an interesting stat. This is not just any list of companies. This is the sources of capital for the Inc. 500 companies, right? So these are the 500 fastest growing companies. I think this was a couple of years ago, maybe in 2014, right? So of the 500 fastest growing companies in the US, 6.5% raised venture funding, 7.5% raised angel funding, right? So there are there are other ways to build a business, and that's sometimes worth reminding ourselves, especially when you sit in the Bay Area as I do, and most entrepreneurs and investors are kind of hardwired to thinking about just one way to do things, one way to fund a company and build a company. And then the other thing we always have to remind ourselves and founders is what they're signing up for, right? When they take venture funding. And Andrea touched this point very well in his intro, but it's I think people sort of know this, but don't always sort of fully realize what it means, right? It's what this chart shows is the distribution of returns across many venture investments, right? So, and this is consistent across most venture funds, or even the very or actually especially the successful ones, right? That you talk to and you ask them, well, how many of your companies will zero out, right? And how many will make money, and how many will make a lot of money, right? And I think there may be a little bit of confusion around why venture funds need to always shoot for massive returns. Like, why do you need to get a 10x or 50x on this investment? Wouldn't you be happy with a 3x? Well, you would be happy with a 3x as an average. But with knowing that 60% of your companies are not going to return your money, you actually have to hit some get some very, very strong wins to make the numbers work, right? And so actually in kind of the venture, if you read the venture capital bloggers, they'll say things like, I mean, there's really about 5 to 10, at most 20 deals a year in the venture industry that matter and drive 90% of the returns in the industry, and everybody's trying to be in those deals, right? So when they look at any of those companies, including some of the examples I listed above, they should be asking the question, does that business look like it could end up at the right-hand side of this x-axis, right? Could it generate a 10, a 20x, a 50x? The rule of thumb is, can it return the fund, right? So if I have a $100 million venture fund, does this have at least the potential of having an exit big enough to return my entire fund, right? And so that's what you're essentially signing up for if you, as an entrepreneur, right? And so that's the venture model. That's how, I mean, I don't think anybody's really figured out a better way to invest to deploy venture capital, sort of early stage equity dollars. That is how the distribution works, right? And which there's a sort of a reason why they have to swing for the fences. But there's a saying about about home runs, where if you want to hit a lot of home runs, you by definition have to strike out a lot, right? I read a quote once about Babe Ruth being not just the king of home runs, but also the king of strikeouts. And those things are actually, linked and, almost saying one and the same, right? You have to swing for the fences. And when you swing for the fences, you miss more, you miss a lot. So the question we ask ourselves, and kind of tying this back to transform finance and as impact investors, is, this might be the right model for venture capital, but is it the right model for everyone, right? Or for everyone else? Is it the right model for these companies? Is it the right model for society, right? So driving 7 out of 10 companies to failure, I mean, driving to failure might be strong words here. I mean, they're not all driven to failure, but certainly, again, by pushing the gas pedal very aggressively, more do fail, right? Because they prioritize growth over profitability. They burn a lot of cash, increase risk, and a lot of them fail. So what are some of the adverse effects there? I mean, you think about the founders. A venture fund, a venture portfolio might have a couple dozen companies or more in it. So if 10 fail, not the end of the world, right? They can succeed in others. But for the founder, that's their life, right? That company is their life. And if it went to zero, it can have very significant consequences financially, in terms of relationships destroyed. We like to kind of glorify failure here in Silicon Valley, but for a founder, failure can have pretty significant consequences. And then this goes back to the point Andrea raised around diversity and right of venture capital. Who are the founders who can take more of that failure risk, right? If you and even looking at the data I shared earlier, sources of funding, the number one source of funding is personal savings, right? So the founders who can shoulder this risk are the ones that have more, come from a more comfortable financial background and can afford to fail. But if you're an entrepreneur from a low income background, taking on, would you rather shoot for the moon and with a 90% chance of failure, or would you rather have build a business with a greater success probability? And of course, there's other. It's not just the founders; it's all the employees, workers. And the other thing Andrea referenced here, the pressures of venture capital, the pressures of growth, right? I mean, there certainly is kind of this increased risk of you're having to justify those valuations. You're having to create a lot of value for investors, you're less able to think more broadly about stakeholders, right? I mean, if so much value has to go, if a venture fund has to return the fund, right? Are you creating enough value as a company to do that and share wealth and profits and ownership with workers, or that sort of thing? Unlikely, right? So we think, I mean, there's a lot of companies that don't fit that mold, some that are not likely to have an exit. You're building a regional CSA business, could be great profitable business, just not likely to exit. You're doing e-waste recycling, right? You're in emerging markets where the M&A IPO environment isn't as robust. There's a second category of companies that are not likely to want an exit, right? Where they could go down this more conventional sort of venture path, but they, for various reasons, want to maintain control. Mentioned a couple of names here in terms of really wanting to hold on to kind of the mission DNA of the company. Companies like Change.org, traditional medicinals in the tea company, and even companies are not necessarily ones that you would think of as an impact company. A company like Buffer that does build social media tools, but where the founders have sort of decided that they don't want to sell because they have a profitable business with a very so this extreme commitment to transparency and ethics, and don't want to sell, right? Or a third option, a third category, just could go the venture path, could have an exit, but maybe just not big enough, right? It just goes back to those rules of thumb. I mean, if you could sell some data for 10 or 20 million, that might be a very nice outcome for the founder if they own 30% of the business or more, but it might just not cut it for the venture investors. So we see this as kind of breaking a bit of a false dichotomy in the venture world, where you were either a VC business where you should grow and go big or go home and burn a lot of money, or on the other hand, you're a lifestyle business. A lifestyle business where you don't care about, you just have to bootstrap it and raise some bank debt, and it's a little business and it doesn't matter. We think there's a lot that falls in between. Call it hybrid. Some people have called it indie, as independent businesses. There's a venture fund now called Indie VC that has been created to support those businesses. So it may not be big enough, may not be fast enough for VC. They may just want to remain independent, and they are pursuing growth, but they're also prioritizing profitability and the wish, and again, the desire to be more independent and control of destiny. So now I'm going to get into this here. We'll get into more specifics around terms with the work that Rodrigo is doing. Just to give you here, this is a sort of a flavor, and the range of, I said earlier, we don't want one tool. We don't want just a hammer and go around looking for nails. We want a screwdriver and a hammer, and we want a lot of different tools, and we're seeing more tools emerging, right? So there's equity-based structures where rather than expecting an exit, there's the expectation is that the company can buy shares back over time, or can distribute dividends over time to investors. There's debt structures that are more flexible than kind of traditional bank debt, and where they're tied to performance, either revenue-based or kind of profit-based loans. So we're seeing all of those, and what we're kind of looking for, and working on some of those, and what we're looking for increasingly is how does this get implemented across a portfolio, right? I'd say it's still as far as we know, a relatively a small landscape of funds that are trying to implement these sort of structures sort of intentionally across a portfolio, but there's a few, and it's growing. So Adobe Capital is here, and Rodrigo will discuss that. So here's a kind of, these are in three buckets here. These names. Right? One is funds that are using revenue-based loans, and some that are doing that at the very early stage, like Fresh Source Capital and Village Capital, that are doing it more and more frequently. Others like Adobe Capital, a little bit later stage, and our DC Community Ventures. I think Kareem is on here, so from DC Community Ventures, and something they've used effectively in their portfolio. And then on the other hand, the two other categories here are equity-based. There is this concept of a revenue-based equity redemption, where the companies used a % of revenue to buy shares back. And we know Looney from who ran the Fledge Accelerator and is now launching a fund called Aviary, basically trying to apply that structure across a portfolio. And then typically at a slightly later stage, typically more of a growth stage, we're seeing fund managers that are using what we would call sort of a put option, right? So there's not an ongoing stream of repayments or distributions for investors, but there is an expectation that 5 or more years down the road, the exit is very likely going to be share either a refinancing or a buyback. And two examples here is Investico, a fund up in Canada that's investing in sustainable food companies, and the Builders Fund. And so theoretically, how we see that working across our portfolio, we see it being a smoother distribution with not necessarily any lower financial returns than a venture strategy, right? So on the left-hand side of again this slide, there's what a venture fund distribution might look like, and in the case that it actually plays out well, where they get one or two pretty strong exits that drive returns at 10x or 7x, a few zeros, and kind of an average of 2.3, 2.5x on the portfolio. And then what it might look like for one of these funds that are using more like a revenue loan, where they're shooting for a 2 or a 3x for most of the investments, and there's not an expectation for a lot of write-offs. Always be some write-offs, but you're sort of expecting to get more of these singles, doubles, no home runs, but hopefully the average can be fairly consistent. So in case I made this sound too easy, and like, why don't we just do this all the time, everything, everywhere? Just a few challenges to keep in mind that come up. So one question that often comes up, and I think justifiably so, is a question around follow-on rounds. So you invest in a company, and they are paying some % of revenue over time back to investors, and then a year later they go out and they want to raise a venture fund or an equity round. And how does that work? Does that turn off other investors? So I think there's we think about that question in sort of two. We think about it, and we think there's sort of two categories of companies largely when we look at this, right? I mean, there are companies where realistically that's just not going to happen, right? I mean, they will not, they should not raise venture funding. It's just it's always going to have to be something alternative, and then they're either already know that, or they're going to realize it at some point, and so that is less of a concern. And then there are companies where I think they could go either way. I mean, there's a scenario where they could go down this more moderate growth path and get to profitability and just keep going. And there's a path where they could take off and want to raise more conventional equity. And in those cases, I mean, I think two things to keep in mind. One is it does make us think more favorably on debt, to favor debt, in that as a new equity investor, as a new venture investor, if you're coming into a company and they already have some debt, even if it's a little bit unusual in how it's structured, it's debt, and you're used to seeing that. You probably invested in companies that have taken on venture debt, so it may not be a deal breaker for those guys. And then the other thing is we might think about optionality for us. So I know Rodrigo probably is going to discuss this too. Have a conversion feature, a convertibility. So if they do go down the path and everything is going great and they do decide ultimately to take that fork in the road and raise venture funding, maybe we'll rethink our position and we'll decide to convert into that Series A. So that's another way to go. Another typical challenge, I would say, is co-investors. So I mean, there is certainly a community of investors for whom this is great. This is what they're looking for. They'd love to see more of their capital cycling back and through and getting some stream of returns from their companies, and this actually makes it easier to raise money from those investors. But there are many investors that don't want to, are constrained. They have a venture fund. This is the only tool they can use is a venture term sheet, and so this is, it places the onus on us sometimes to be able to come to the founders and say, well, we think we can, help raise the rest of the round. Or else they, as a founder, you might rightly think, well, if I like the idea, but if the capital is not there, I'm gonna go back to where the capital is. And then thirdly, there are
Aner, if I may interrupt you, have you noticed that in practice? So founders that would have been open to this idea but were concerned about the co-investors aspect?
Yeah, all the time, and I mean, it's not unfounded. I think if you're an investor, probably one of the most common things you'll hear from a founder raising is, we just want to do this quickly and get back to running our business, right? And this is usually not the quickest way to go, right? The quickest, and unless you can't raise money otherwise, right? In which way it might be the only way to go. But downloading a standard convertible note and going to the local angel network and not discussing valuations, not discussing royalty rates, is probably the most the easy way to go, and a lot of it, and it's what people know and are mostly comfortable with. So I mean, I think there needs to be some real buy-in, right? I mean, the founders need to either, again, kind of a last resort, or they have to believe that it makes sense for them as well to go out and look for investors to spend a bit more time.
Yeah, and I imagine going back to the impact terms project that Bruce was mentioning earlier, as more of these deals get done, they could become faster and easier for the entrepreneurs, right? So there is a kind of a scaling effect there.
Yeah, no doubt, and some of the examples I had above. I mean, Village Capital uses a standard term sheet, standard revenue loans, very simple. I know Looney has a pretty standard document. So people are standardizing documents. The question is how. I mean, they then have to kind of potentially build a community of co-investors that would be comfortable jumping into those standard documents, right? But yeah. Thirdly, I mean, the question that often comes up, in very much related to this point around, well, I don't know this. I mean, I know what convertible notes. I know these preferred equity term sheets. First time I've done one of these. Like, what does it mean from a tax perspective? I could do the very I don't know. I could provide the short and bad answer, or I could I could let Bruce chime in here a little bit. What whichever whichever way you.
Yeah, let's say, Bruce, would you be willing to chime in a little bit on the tax considerations of these alternative deal structures?
Not to put you in the spot, Bruce.
All right. Well, why don't you
Yeah,
try?
yeah. I'll try. I mean, you know, at a high level, I mean, I earlier described one reason why we like debt, right? Which is that if you are going to have
Oh,
follow-on.
sorry, Andrea.
Oh, hi.
And there, sorry, I didn't realize I had my phone on mute, so I'd be happy to.
Thank you.
If you still like me to.
Yep, you saved Aner at the last second.
Okay. So just quickly, and this is with respect to U.S. investors. This would be tax implications for U.S. investors, whether they're investing domestically or overseas. And I haven't researched whether it'd be kind of similar issues that might arise for non-U.S. investors. But my guess is not, and this is just kind of, you know, the U.S. IRS likes to make things really, really complicated. But the basic potential issue is that I guess there's really kind of two potential issues. One is that when you're basically starting in some cases to potentially try to make a debt instrument look a little bit more equity-like, or an equity instrument a little bit more debt-like, the IRS does have the ability to essentially recharacterize the deal that you've put together. So even though you might have something that says, well, this is a promissory note, this is a debt deal, in theory the IRS could look at it and say, well, you know, I know you titled it a debt instrument, but really, in our view, it looks more like equity, and so we'll kind of recharacterize it and tax it differently. Now, I'd say the risk of this is relatively low, and it's more of a risk if you haven't, you know, you're trying to do something creative with an equity instrument and trying to make it look more like a debt deal. But it is something to be aware of, and actually on the Impact Terms Project website, by the way, there is sort of a longer treatment around this particular issue and when it can arise. And you know, the second issue that's discussed more frequently is that there are situations in both debt and equity, but more often in debt, where when you have either deferred interest payments, let's say, in debt, or where you have deferred, meaning they're not paid on a regular annualized basis, or if you have a situation where you're doing these variable payment terms on debt, where the IRS can essentially take the position that the taxpayer should be taxed based on a assumed or deemed income schedule rather than based on the actual cash payments received by the investor. And so this means that it does raise the specter that an investor could actually, especially in early years of the investment, be taxed on this assumed or sort of fictional income, and have to come out of pocket to pay taxes without actually having received a cash distribution. Or the investor could have received a cash distribution but actually have to pay tax on an assumed amount that's higher than the distribution. So this is, I will say that this is sort of the technical answer. Technically, the borrower is supposed to actually file a report with the IRS saying, I have created this sort of assumed income. It's called OID income. You know, I've entered into this investment transaction that's created this assumed income, OID income, and actually report the amount of that assumed income to the IRS. Now, I will say that I don't think this happens frequently. I think a lot of certainly a lot of companies are not aware of these rules, and even a lot of investors are not aware of these rules. And I think even some people that might be aware of it just sort of take the position that the risk of non-compliance is low enough that they may not actually worry about it that much. But I do want to kind of, again, explain sort of the technical issue. I think, and often from a compliance standpoint, of course, non-compliance can create penalties and kind of accrued interest when the actual tax is paid. Where this can create the biggest problem from a compliance standpoint is a situation maybe where you have a U.S. company and actually, and I think I actually misspoke. So this can apply it always applies to U.S. investors. It can also apply to situations where you have a foreign investor investing in a U.S. company. And the issue there, and this is actually a bigger issue for the company, is that technically, if the company creates this kind of assumed income, it actually has an obligation with respect to foreign investors to withhold a certain amount of tax on that assumed income. And the penalties for failure to withhold are actually much higher, much more egregious than the penalties for the failure to comply just with this OID tax regime. So I would say there should be particular sensitivity for U.S. companies that are doing this kind of arrangement where you might have non-U.S. investors. And hopefully that was somewhat understandable. And I think Rodrigo might actually address sort of how the Adobe fund has again, as a practical matter, dealt with some of these issues.
Wonderful. Thank you very much, Bruce. Go ahead.
Well, I'll just say at a high level, it just says, it sort of means that from a tax perspective, right, we're always going to prefer to structure this as equity, right? I mean, even putting aside some of these complexities that, Bruce outlined, even just by virtue of if it is structured as equity, any share redemptions are, capital gains, or dividends are taxed as dividends, so it's a lower tax rate than interest income in the case of a revenue loan. The trade-off that we face is that these debt structures are simpler, are easier to document, you don't have to deal with valuation. It's a simpler document, a simpler negotiation, fewer terms. And as I said earlier, being a debt provider, I think has some benefits as an investor if you do expect them to go out and raise equity at some stage. So that's sort of the trade-off. I think if you're investing out of a tax-exempt entity, then maybe it makes debt easier because you don't have to worry about the debt considerations. If you're investing out of a taxable entity, then the trade-off is something you have to think through.
Excellent, thank you. And then Rodrigo, if you want to, during your presentation, to bring up the international tax perspective as well, that'd be great. Aner, was that it on your end?
Yes, I don't. Yes, it says a question. So, but are we doing questions at the end, or?
Well, just want to provide an opportunity there if anybody had questions right now. If you're doing it through the app, you'll see there's a little chat box through which you can send in questions. You can also use, I think there's a flag that you can raise if you'd like me to unmute you and to ask a question. And I will unmute the folks on the phone so that if they want to chime in, they can do it that way, and then I'll put you back on mute. Okay, so, and watch out, you're now all unmuted on the phone. Cool. In that case, I will put everybody back on mute, and I will turn it over to Rodrigo Villar Esquivel from Adobe Capital Thank you so much, Rodrigo, for joining us today. I'm really excited to hear both the genesis of Adobe Capital, how you all came to using this as one of the main structures for the fund, and also hearing about the fund too that you are currently raising for. So thanks for joining us, Rodrigo.
Thank you very much, Andrea. Good afternoon, everybody. Thanks for your attention. Just to give you, you can control the. Adobe Capital is the financial arm of New Ventures. Just to give you a very quick background, New Ventures was founded in 2004. It was a program that originally was funded by the World Resources Institute. So the WRI 15 years ago, they thought that we needed to find strong success stories from environmental entrepreneurs in order to prove that more capital can flow into solve some of the environmental problems that we were looking at. So they created New Ventures program as a business accelerator to find these entrepreneurs across developing countries and to link them to investors so we can have that proof of concept. So we ended up having programs in China, Indonesia, India, Colombia, Brazil, and Mexico. Eventually, New Ventures Mexico did a spin-off. We started doing different things, always related to the same mission. We want to prove that environmental social companies can be as profitable as traditional ones. So we've been doing a lot of things regarding that mission. Mainly, we do acceleration. We support about 50 to 60 companies per year across Latin America with acceleration services. And we have Adobe Capital, which is I'm going to get in detail on what's Adobe Capital. And we also have another company that does a lot of promotion. So we run the biggest impact investment conference in Latin America. We have been doing that for 5 years. We also run one of the biggest environmental festivals in the region. We had like 100,000 people together in a weekend, and that's in Mexico City. And we have a couple of communication platforms, magazines, and media that supports green consumption and promotes like more sustainable cities. And so that's the whole thing we do as New Ventures, promoting the mission. So back into Adobe Capital, we after 7 or 8 years supporting green and social entrepreneurs, we believe that we saw some of the best companies in Mexico at that time. Even one of the companies did an IPO. So we started seeing a lot of great deals, great companies that they were very successful, but they were not raising the equity that they were willing to. Probably because they were too small for the incipient private equity industry that was at that time in Mexico, and secondly because there's for a lot of these entrepreneurs which are working in social environmental industries, most of these industries are not mature enough to think about exits or to think about potential mergers or potential bigger players who can acquire these companies. So and in the other reason is that probably it seems that it's a common in developing countries that not all entrepreneurs or not all the business people they want to sell their companies. Sometimes they don't even know what that means. So we saw a lot of great entrepreneurs doing great things, but when you had an approach as an investor saying, okay, you have to have a drag along and say like, why I have to sell my company? Why you need to force me to sell my company if I don't want to or if I don't need to? So we started looking at a lot of the things. So we ended up structuring a fund to meet the criteria of the best companies we were looking through the acceleration program. So and that's Adobe Capital. And after a lot of probably was a couple of years of studying a lot of mechanisms, we came out with the thesis that we needed a fund that would be do structure exit and mezzanine funding. So it took like about 3 years to raise the first fund. It's a $20 million fund, and we're closing our 7 investments so far, and that's kind of the story of Adobe Capital. The sectors that we operate, we like a lot: healthcare, education, housing, alternative energy, access to financial services. And we believe it's not just because there are social sectors. We believe that in Mexico and many other developing countries, they're the companies of the future. Like if you want to invest in technology, you will go to Israel, you go to Silicon Valley, not in Latin America. I think Latin America, the growth of the industry, the growth of the companies are in providing services to the people that doesn't have, like basic services. There's a big need, and there's still a lot of opportunities to do business in those sectors. So yeah, I think Aner explained a lot of about this mechanism of quasi equity or convertible loans or mezzanine. I think there's a lot of terms, but it's very simple. So on the one hand, you have debt. Usually, debt it's like traditional debt. It's not flexible at all. Usually, you cannot provide debt when the company doesn't have like a proof cash flow or steady cash flows. So otherwise, the company, even if they have the hockey stick growth, there's going to be a period of time in the growth of the companies where they're going to struggle to make the payments. So it's not flexible. If they usually companies when they're in the growth stage, sometimes they have a lot of cycles. So and traditional debt is not fit to these entrepreneurs in many cases. Usually they need to put their house or to put a big collateral, and sometimes they don't even have that too. So traditional debt doesn't work for that. And on the other hand, for investors, traditional debt you cannot share the returns of the company. So you have to fix them up in a certain IR. So it's hard to get the upside if the company is doing well. And on the other hand, equity. Uh, Equity it's fit a lot the entrepreneurs in terms of growth, but it doesn't fit in terms of selling the company. It doesn't, and honestly, there are very few exits in developing countries to think about that equity it's going to be a product that's going to fit for all of the entrepreneurs. So what we believe is there's something in the middle, which is a revenue share, where you can have a percentage of the revenues. That's what we're doing. So and you can share the risk with the entrepreneur, and you can align the incentives to have successful companies. Um, so I probably said told you a little bit about this. For 7 years, we supported tons of companies that were not getting funded, and that's where we developed the Adobe Capital. So Adobe Capital is a very straightforward fund. We didn't want to reinvent the wheel. We didn't want to came out with LPs with something completely new, because we thought that was going to be impossible to raise a fund with something that's completely different to what is the industry. So our fund is a very plain vanilla fund. The only thing we changed and we could negotiate with our LPs was to reduce our returns to expectations to 20%. Usually, traditional VC funds they're targeting 30% plus in the return. So we as we are mezzanine fund or convertible loan debt, we reduce that 20%. So that's one of the small tweaks we did to the traditional model. We also have a 3% management fee just because we're a small fund. But that's probably the only things we changed from the traditional model. Otherwise, it's pretty much very plain vanilla to all traditional venture capital funds. Um, so we're in the middle. We believe that usually is when you have debt, you have a very low risk. You have something warranty. You have like a collateral, and when you're equity, you have a highest risk. So we're in the middle doing quasi equity. And so, what is entrepreneur seeks? Entrepreneurs are looking for unique financial solutions. Uh, Again, if you go to Silicon Valley and technology, most of the entrepreneurs are kind of structured the same way. They sometimes they have the same period of time to develop the pilots or to scale their companies. In developing countries, it doesn't work like that. The entrepreneurs take different times. Industries are different. You have a big hand of the government. Usually, that's another thing. Like usually, social enterprises, we're using these industries like health, education, affordable housing. All of them are very linked to governments. and that's a big problem. So, all of them have subsidies, so you need to companies works in different times that probably some more traditional entrepreneurs. So they need tailor-made structures. They need flexible costs. They don't want dilution in many times, and they want smart money as well. So they don't want to just like a loan from the bank. They also want people to be in their boards. They want support. They want partners who can open doors and help them grow in the business. On the other hand, the investor seeks risk-adjusted returns. They look for exits. That's very difficult in the region, and they like the self-liquidating instruments, and you can also have a steady stream of cash flows. If you see this example is very straightforward. The traditional bank debt it has fixed payments. It doesn't matter if you're doing well or you're doing wrong. Like if you're underperforming, you don't have cash flow. You still have to pay, otherwise you're gonna get your collateral. They usually look for collateral. Sometimes, in the case of Mexico, sometimes they're asking three to one in terms of the value of the collateral, which is really hard for an entrepreneur to put their assets or their home in order to start a business. And it's a one size fits all. No? The banks do not have the flexibility to develop specific products for each entrepreneur. What we are doing at Adobe, we have payments linked to performance. So we usually link the payment to a percentage of the revenues. So if the company is in a bad cycle or if the company underperforms a month, they don't have to pay. If there's a really good month, the entrepreneur is going to pay more. It's convertible into equity. So just in terms of filing, we usually document this investment as debt, but we can convert into equity. And I'm gonna explain a little bit more how can we convert. It's smart money. We as New Ventures Group, we believe we're the smart money in impact investing, not because of Adobe, because also with the whole platform we have, we can open a lot of doors. We have a lot of information, and we can provide a lot of value add to the companies that are in our portfolio. And of course, we can do tailor-made investment designs in the companies. Uh, the good thing about this structure is that the incentives are completely aligned. And so the way we structure the deals is that usually we set up a multiple. We say average investment that we do is we're going to set like a 2.4, 2.5x return on our investment. So we usually do the financial modeling from scratch, and we're really good at that. And that's where we put a lot of efforts to have like a very well done financial model. So once we have the financial model, we can figure out what percentage of their income or revenues are gonna be able to be paid by the company, so we don't struggle the company. So usually we can give them a grace period of 1 year, 18 months, and then the company start paying 3, 4, 5%, depending what the financial model can say. And and we put some expectations. So in a traditional model, we would set up 2.5x return, and the company in a base case model, they're gonna be paying in 4 or 5 years, for example. So if the company is underperforming, instead of paying in 4 years, probably they're gonna finish paying in 6. In that case, our IRR is gonna be lower, but also if the company performs well, or they're going to pay faster than expected, and of course our IRR is going to get higher. But we always link to that multiple. Um, Adobe Capital has pioneered the use of tailor-made and structure. We have 4 investments to date. All of them are convertible loans. And so, as I was telling you, we usually have a grace period of 12 to 18 months. It's royalty-based payments, and it happens usually it's every 3 months. The fixed equity multiple, it's like 2.3 to 2.5 on average, depending the risk, depending the company. And it's convertible into equity at a predefined multiple. Usually, we combine that from the beginning. Usually, we use like one-time sales or revenues or 5 times EBITDA. So it depends on the company, and it also depends on the negotiations with the company. We usually have a board seat. in all the investments, and we have extensive minority rights. Probably the same ones we will have with an equity investment there. As I told you, the Adobe platform, we have the financing through Adobe Capital, we have the acceleration program through New Ventures, and all the ecosystem building that we have through our Impact Investment Forum and the other initiatives we have to increase awareness of impact investing. And the pipeline, I think we have like a really extensive pipeline. This is the way it looks. You can see that we probably, out of 1,000 companies that we review, we did 6 investments. This includes also all the companies that came through the business accelerator. As you say, probably through the business accelerator, we screen about 1,000 companies. We had initial contact with more than 300 through the fund. We went to a preliminary analysis to 125. We negotiated term sheets with 31, and we took 8 to the investment committee. We 7 to due diligence, and so we invest in 6. That's a little bit how our deal flow looks. And as you can see, 28% alternative energy, 21% sustainable products, 17% health. That's kind of the most dynamic industry we have seen in Mexico. We have 6 companies in the portfolio. We have one company you see in Tijuana. It's a company called Provive. It's a company that it's buying abandoned houses in Tijuana, Ciudad Juárez, and Mexicali across the border. There's a big problem in Mexico. Like there are some developments that were made in the past for low-income developments, and some of these developments, they just buy land in the middle of nowhere. They build 20,000 houses of 4 meters big, and some of these developments, about 60% are abandoned. So that brings a lot of insecurity, a lot of gangs. So what Proviv is doing is they're buying the abandoned houses to the banks, but they're also building on supporting to rebuild the neighborhood and the community. So they increase the value of the properties by doing this, and it's a great company. We have another company called NatGas. This company is in Querétaro. They are converting taxis and public transport to natural gas. This company is growing 15% monthly, and within a year they change 30% of the taxi fleet of the whole city to natural gas. So a traditional taxi driver will probably be earning about $300 a month. Once they convert to natural gas, they probably can double their income, and also, and of course, much more better for the environment, as they can reduce a lot the pollution. And our company is Finae. Finae is it's the only, just to give you some numbers, there are about 700,000 students that finish high school, and they cannot get a place in public universities, and they cannot pay for a private university. Finae was the first company to do traditional student loans, and also was the first company to do a securitization of their loan portfolio in the stock market. So now individual investors can buy education bonds and finance people to go to university in Mexico, thanks to Finae. Sala Uno, it's a company that's doing eye surgeries. This company is doing about 5,000 cataract surgeries per year. It's a company that it's 70% cheaper than its closest competitor in terms of doing eye surgery cataracts, very similar to Aravind model in India, and they are great entrepreneurs. Habitat, it's a company that's doing affordable housing in rural areas. So basically, families that already own the land, but they have like a cardboard house or a cave, or really very bad conditions. So Habitat is building houses for them. They're about $8,000, $9,000 houses for these families. There's in Mexico a lack of 7 million houses. So it's a kind of companies that if you want to see these like building 7 million houses, there's no enough money from philanthropy or government to deal with this issue. But if you tackle it from a model that is actually profitable, it's a better way to approach this problem. And Bioorganimex is a company that's doing sustainable cleaning products, and that's kind of the portfolio we have across Adobe Capital. And this is the evaluation performance so far. If you can see the blue lines are in pesos. The orange ones are in dollars. Probably is not the best time for Adobe Capital to talk about this because our currency dropped like 50% in the last year. So that's why we wanted to put the returns both in pesos and dollars. So you see the returns in pesos. So far, the average return we have is 17.5%. But a lot of the companies, all of them are overperforming. We don't have write downs, we don't have write offs. So we have a very strong portfolio, and it's very aligned to our expectations. In pesos again, in dollars, it's a shame, but it's something it's happening to all developing countries. The currencies have dropped a lot, and the case of Mexico has been one of the currencies that has been
Can you tell
more.
us, Rodrigo, a little bit more? So, since we went through the different investments in a pretty disparate set of sectors there, can you tell us a little bit more about how you've seen this mezzanine debt model working across the sectors? Are there some in which it seems to be more suitable, and for what characteristics?
Well, yeah, we each company is different. I mean, what we find out is that some sectors, for example, we have two out of these six investments I was telling you. So we have four of these investments have been mezzanine, and two has been equity, and that's the way we structure fund. When we first structured fund, we thought that we need a couple of plays in equity that could probably increase the returns of the whole fund. So the deals we have in equity, it's FINAE, which is financial. It's education, but I mean it's a financial company, and Sala Uno, which is health. And those both of them are sectors that we believe that there are a lot of big players, and we can see a possible exit. Actually, in FINAE, we already got a couple of offers from different banks to acquire the portfolio of FINAE. So it's not the right timing, but potentially we see once we increase the portfolio of FINAE, the loan portfolio, we see that it's very feasible to I don't know, from another financial institution to acquire FINAE as an equity play. So FINAE, it's almost close to $80 million right now, their loan portfolio. So I think once we reach a little bit of volume, I think it's going to be much more attractive to a lot of financial institutions. So as I told you, we already got a couple of offers to exit. Probably we haven't got to the right valuation or the right timing, but we're sure it's going to be an exit there. In the case of Sala Uno, they still in a very growth, like burning a lot of equity, opening a lot of shops across the city. So, but I mean, we did a second round of capital, and we had 5 term sheets of different venture capital funds or family offices willing to put money into into Sala Uno. And we also see in health in Mexico, we see a very dynamic industry. It's consolidating, a lot of big players trying to acquire different models. So in those two, we saw a potential exit. Also, so I would say in one part is the industry. Those both of them are industries where you see a lot of mergers and acquisitions. A lot of they are both very dynamic industries. And on the other hand, entrepreneurs, both of them are more safe entrepreneurs. For example, in Sala Uno, both of the entrepreneurs, they are MBAs. They both actually they met at Rothschild. They both were investment bankers, so they know even from the beginning they knew that they want to sell the company. So in one hand you have the industry, on the other hand you have the willingness and the knowledge of the entrepreneur to build a company that actually was built to be sold. So
And going back to Aner's earlier point about the risk of mission drift upon this exit, is that something that you looked at with respect to FINAE and Sala Uno?
Well, every investment we make, of course we are funded, we are GIS rated. We measure all aspects of these companies, but at the end, the decision we take about investing or not, we like companies where the impact is completely aligned with the growth of the company. For example, FINAE, the only thing they do is to help students to go to university. So the more it grows, the more that people is going to go to universities. It's the same for Sala Uno. The more people they perform surgery, more people is going to recover their sight. So just to give you some numbers, Sala Uno, there's about 2 million people in Mexico that are blind or close to be blind just because they don't have $3,000 to pay for a surgery. So now Sala Uno can do that for $800. So it's much more accessible. So the more surgeries they perform, the more people is going to recover their sight. So usually all the companies, where you see all the companies we have, it's completely aligned. So we don't fear about that. I think if somebody wants to buy Sala Uno, is because they wanna probably increase their portfolio of services to the bottom of the pyramid. And we believe that if somebody purchases Sala Uno, the only good thing that's going to happen is that more people is going to recover the site. We don't think that somebody's going to
Um,
buy Sala Uno to change or to shift the social mission of the company.
Right. So in the case of the Adobe portfolio for this Fund One, there was less of a concern overall from using venture capital because around the mission drift problem. It was more really in terms of the type of capital that was needed by the entrepreneurs.
Yes, yeah, it was a solution. I mean, we needed capital for these entrepreneurs, and we thought for the situation of Mexico, the characteristic of the country of entrepreneurs, we thought that it was the most suitable financial mechanism to support these companies. And I mean, and it's very linked as well to the industry. So most of the social, as I was saying, there's a lot of social entrepreneurs, they don't want to sell their companies. For example, in
Right.
the case of Provive, it's a company is doing buying affordable housing, and so we don't see who would be buying a company like Provive. The
Mm.
same for Habitat. There's not like a super big developer focusing into social, into rural housing. So uh, and both of them entrepreneurs, they're people that created their companies to support these families. It's kind of a mixture, but we believe that this mechanism is the best to not just, I mean, for the impact investment industry, it's super aligned, but I think for many other industries, it's a great financial mechanism, more to the characteristics of the developing countries.
Mm.
I mean, the
Aner,
downside is that,
were you gonna
yeah,
say?
sure,
Oh, I was just going to say, I mean, it's not the case that we would um, categorically be opposed to exits, from a mission perspective, or like all exits are bad and can jeopardize the mission. I think it's probably the case that different companies and different business models can have more or less sort of propensity to having to being compromised, right? Certainly, I can think of, financial services is one that we are always very sensitive around. And I mean, there's the fact that you're providing financial services for lower income borrowers, by no means makes you a more ethical, player, right? Could be quite the opposite.
agreed.
um and the other thing is, I think it's not it's I don't want it to be only focused around the exit, kind of the end point in the process. You also, I mean, we talked about the process itself, right? So getting there, and um, we see these examples all the time of the risk of the pressure, right? The pressure of growth, the pressure of growing fast and heading to an exit. And so that can, in many cases compromise ethics and how you think about customers, how you think about suppliers, how you think about workers. And stories come out of Silicon Valley on a weekly basis, right? And whether or not it's an impact company. So you can have a great exit that makes investors and founders and workers hopefully happy, and doesn't necessarily compromise the impact. But I think the nice thing about these models is that hopefully with these companies that are sort of prioritizing profitability and cash flow, they have the luxury, the independence um, to pick and choose, right, when and who to exit to.
Sure. No, that's right. I mean, in the case of, and we see that, like in the case of Finai and Sala Uno, there are equity plays. I mean, we do a lot of work a lot in the board at the board level. You know, like for example, for Finai, we invited to co-invest with us. So we have a media network as investor. We have Elevar Equity as investor. We have Bamboo Finance. So all the institutional investor of that company, I think we are impact focused. So there's a strong pressure of, we don't want to invite somebody to invest with us if he's not aligned to the values of the company. So I think as a whole board level, all the investors there have this impact focus, and we, I mean, it's something we're gonna try hard to keep the mission. But we believe that the idea of these companies' main product is to solve a problem. Like the core business is doing financial loans. I mean, it's harder that to lose. Is I don't know, like it's like when Unilever was acquired sorry, Ben and Jerry was acquired by Unilever. There was a big risk of losing a lot of the values of Ben and Jerry's, but because it's ice cream, you can just change the quality of the milk, or you can stop giving loans. So it's easier to to lose the value of the company. But when you are building affordable housing, I mean, it's not that you're gonna, if you're acquired by another company, they're gonna start doing something different with the product. So we believe that uh, that's gonna happen, and of course, I mean, we're gonna try. I mean, we need to maximize profit, but we're gonna be very careful with that.
Can you tell? Good. Can you
Sure.
tell us a little bit about the lessons learned in Fund One and how that has informed the way that you're looking at Fund Two now?
Yeah, well, the lessons learned. Just to give you, there was a here just some numbers. 100% of our portfolio is still active. Last year, the average revenue was 87% of the portfolio. We don't have write-offs. We don't have write-downs. 50% are already repaying the loans, and the average ticket is 1.6 million. So it's just like to give you some examples that our portfolio is performing very well. We believe our portfolio is actually probably more solid than venture capital funds in Mexico. Some of the lessons learned we had is, I mean, we learned a lot in the past in terms of how to structure these uh, things. We have been working a lot with the lawyers in terms of how we document the investment. In the case of NatGas, we did both. We invest a little percentage of equity and another percentage of debt, and it's something we believe we will not do again. Uh, just because wearing the two hats, it's sometimes difficult at the board level. So that's a lesson learned. Uh, but to be honest, it has been working very well. So for the second fund, we're targeting to do the same thing. We're not going to be changing a lot of things into that.
If I may,
And
one last question on that was
sure.
more probably around the roll up, right? Because we've seen this done in terms of direct investments into companies, and I think you're one of the few funds, except for probably Village Capital, I think, and the other ones that Aner had mentioned earlier, where this was done more at the fund level, or at least at a meaningful fund level percentage of the deals. So if you're starting with Fund Two, I imagine it's because you haven't seen it as a downside to actually having it across the fund.
No, we haven't seen a downside. I think the fund two is going to be structured very similar. We are seeing it's going to be bigger because we are actually attracting, or we are seeing that the industries are maturing, and we are seeing bigger deals. Still small. I mean, we don't see more than we don't see where to put more than $50 million. So 40 is it's a number that we feel comfortable that we can allocate into these companies. More than that, we don't see the market. Um, but I mean, I think it's working well. We also learn a lot. I was telling you that it also works in some things we never thought it could happen. But the just to give you one anecdote, like Greenland, which is this company doing biodegradable cleaning products, they they got into a fraud in the bank. So all of our investment, it was like $200,000, was stolen. So basically, somebody stole steal a check, and they were connected with the people in the bank. So they 2 days after we put the investment in the company, the whole almost the whole amount was stolen. Uh, so I mean, for an equity deal, that would be a write-off. Like just like the 50% of the value of the company disappeared at that stage. And in the case for us, we were still senior debt. So the owners of the company, the entrepreneurs, they invited their families. They gathered some money, and they recovered I mean, they put more equity into the company, and they still paying our loan. So I mean, it's like something we never thought we were gonna work our instrument, but it did. I mean, so it was like a really tough uh, thing we had to deal with. Actually, one of the partners of the company left after this problem, but they're still paying, they're still growing. It was an interesting mechanism just to see how to put it in the real life. Um, I don't know.
Sorry, I wanted to make one quick comment about performance because I had a little chuckle when you said, Rodrigo, that you had to get the LPs had to approve that the target return is 20%, only 20% IRR, because the venture returns are 30% IRR targets. And as you know, venture performance, I mean, top quartile performance is about 20% IRR, right?
Yeah,
So I always laugh when people say, "Oh, 20% IRR, that's below market." Well, below market if you invested in Sequoia, but not below
yeah,
market if you invested in 75% of the venture fund.
yeah. But you have to say that you're gonna look for 30. So
Right.
what we learn is that nobody gets to 30, but you have to say it. You have to try it. So I mean, it's
So
it's
worth calling out. I mean, if you do hit the 20%, you would be a top quartile, pretty
oh,
much like venture fund.
so
Yeah.
hopefully we're gonna be there. At least in pesos we are there. In dollars, probably we're gonna be slightly below that, but hopefully we're gonna be there. And it's a good thing. I mean, I think as I was saying, we believe that compared to other vintage funds, traditional funds or private equity funds in Mexico, probably our portfolio is more solid than traditional venture capital funds. And I mean, I believe that we share values. There's a lot of things that are kind of like uh, not tangible assets of that we have. The whole platform New Ventures attracts people that are aligned to our values, more ethical people. We have more resources than traditional VCs. I mean, we're just not money. We have a whole platform. So I think that all add-ons to really get good companies. Have,
And for the last few minutes that we have available, as you wrap up with the terms, I believe the terms and the characteristics were pretty similar to the fund one. Was there any overarching thought that either of you wanted to share on? Again, seeing these structures rolled up at the fund level was the piece that was specifically interested in.
well, I mean, we believe that still, as I said many times, we believe this is the right way to go and this is Mexico. Mexico is the second biggest economy in Latin America. It's the 13th economy in the world. But if you go to Central America, Peru, Colombia, which are smaller countries, it's harder to get exits. So these mechanisms for smaller countries, smaller economies, it's the way to go. I mean, we don't have any doubt about that.
Yeah. Yeah. I mean, I would say as an LP, we don't expect to see everybody going this way, but there certainly should be many more doing it this way. And as Rodrigo just pointed out, in some of these smaller markets, I mean, it's almost like that is probably the only way to go, right? That would be the low hanging fruit in terms of shifting from a pure venture model to an alternative model in emerging markets. Certainly, I see.
Mhm.
Like to see many more of these.
Great. Very cool. So I definitely encourage you to get in touch with Rodrigo to learn more about both the experience in Fund One and the terms for the current Fund Two that the Adobe Capital is setting up. Similar characteristics. And here are a couple of resources on the final slide for those of you that can't see it. One is the Impact Term Sheet project that we mentioned before, available at impactterms.org. And you can contact Bruce Campbell on that at bruce@bluedotlaw.com. I also recommend John Kohler's report, Coordinating Impact Capital, that really set the stage for a lot of these alternative and in-between deal structures. And there you have Aner and Rodrigo's emails. Aner is aner@pi-investments.com. And Rodrigo is rodrigo@nvgroup.org. And we are up at the half hour, so I just want to thank you and give you a chance. Yeah, Rodrigo and Aner, if you want to say any last comments before we wrap.
Thank you.
Thank you so much.
Sorry, was somebody jumping in with a question? Or? No. Go ahead, guys. Sorry.
Yeah, nothing for me. Just thank you for organizing. Yeah.
I appreciate it. And I will check for those who are asking whether it's possible to share the decks. If you're interested in the deck, once Aner and Rodrigo have approved it, feel free to send me a note at andrea@transformfinance.org. All right. Thank you very much, everyone.
Thank you very much.
Bye.
Ciao.